Silicon Valley celebrates winners loudly, but attention fades quickly when bigger players arrive. Fitbit once ruled an entire category during a brief yet unforgettable moment. The company created a market that everyday consumers never knew they wanted. James Park and Eric Friedman imagined a future centered around personal health awareness. Their simple plastic trackers quietly changed how people viewed daily movement. Steps transformed from meaningless motion into measurable personal achievements. Early success arrived quickly, but competition moved even faster behind the scenes. For a while, wearing a fitness band became a symbol of discipline and lifestyle. People recognized those rubber bands instantly in offices, gyms, and airports. Fitbit began with a surprisingly simple idea during the early days of 2007. James and Eric drew inspiration from motion sensors inside the Nintendo Wii. They believed everyday life deserved the same tracking previously reserved for games. The first Fitbit device was a tiny clip designed for pockets or belts. It was not a watch, yet it felt futuristic to early adopters. Users enjoyed checking progress directly on a small screen each day. That immediate feedback created motivation few products delivered at the time. During its first launch, Fitbit sold 25,000 units surprisingly fast. That early traction caught the attention of major investors across Silicon Valley. Funding rounds followed quickly, bringing millions to accelerate development and expansion. With capital secured, Fitbit focused on refining both hardware and software experiences. The shift from pocket clips to wrist wearables changed everything dramatically. The Fitbit Flex introduced simplicity combined with everyday fashion appeal. It worked smoothly with nearly every smartphone available globally. Users appreciated effortless syncing and easy daily progress visualization. Celebrities soon appeared wearing Fitbit bands at events and public appearances. Fitness tracking became mainstream almost overnight because of that visibility. This era marked the true peak of Fitbit's early wearable dominance. The company held a massive head start over traditional technology giants. Fitbit software gamified health, turning movement into a shared social experience. Friends competed for step counts, streaks, and virtual achievements. This social loop encouraged consistent engagement and long-term daily usage. Users returned to the app repeatedly without needing expensive marketing pushes. By 2015, Fitbit felt confident enough to enter public markets. Their initial public offering generated excitement across investors and media outlets. The stock price climbed rapidly as optimism surrounded digital health growth. At its peak, Fitbit reached a valuation exceeding $4 billion. They were clearly leading a category they helped invent. However, market leadership rarely remains uncontested for long periods. Powerful competitors quietly prepared strategies while Fitbit celebrated success. Two giants approached from opposite ends of the global technology spectrum. One planned premium domination through ecosystem integration and polished design. The other planned mass adoption through affordability and scale. This marked the beginning of Fitbit's most challenging chapter. Apple finally revealed its long-anticipated smartwatch after years of speculation. The Apple Watch functioned as a mini-computer on the wrist. It featured a vibrant display and deep integration with the iPhone ecosystem. Apps, payments, messaging, and notifications expanded user expectations overnight. Fitbit responded with devices like the Blaze and Surge. These products attempted to blend fitness tracking with limited smartwatch features. Unfortunately, they existed awkwardly between trackers and full smartwatches. Consumers struggled to understand their true value proposition. Apple offered a broader experience beyond basic health metrics. Users could reply to messages and make payments effortlessly. Fitbit remained largely focused on steps and heart rate monitoring. The premium market segment began slipping away rapidly. Apple's ecosystem proved impossible for Fitbit to replicate independently. Meanwhile, competition intensified further from the opposite market end. Xiaomi introduced extremely affordable fitness bands with acceptable performance. The Mi Band delivered step and sleep tracking at astonishingly low prices. Consumers noticed minimal differences for significantly lower costs. Budget-conscious buyers abandoned Fitbit's pricing premium. This created intense pressure from both premium and budget competitors. Fitbit found itself squeezed in the middle without clear differentiation. Profit margins shrank as marketing expenses increased significantly. Warehouses filled with unsold inventory as demand slowed sharply. Retail partners reduced orders, signaling weakening market confidence. Fitbit attempted to pivot by acquiring struggling smartwatch brands. They purchased 𝗙𝗶𝘁𝗀𝗋 and Vector to strengthen software expertise. These acquisitions aimed to accelerate smartwatch development capabilities. However, integration challenges slowed progress significantly. The Fitbit Ionic represented their first true smartwatch attempt. Unfortunately, the device suffered from design and performance criticisms. Users disliked the bulky appearance and limited app ecosystem. Technical issues damaged trust among early adopters. Meanwhile, competitors released improved devices annually without delay. Fitbit struggled to match the pace of continuous innovation. Research and development costs increased while revenues declined. Investor confidence weakened as quarterly results disappointed expectations. The stock entered a prolonged downward trend. The once celebrated $4 billion valuation felt increasingly distant. Cash reserves dwindled as Fitbit searched for sustainable strategies. Management shifted focus toward health services and subscription offerings. The idea centered around monetizing long-term health insights. Monthly subscriptions promised recurring revenue beyond hardware sales. Unfortunately, the pivot arrived too late to reverse momentum. Market perception had already shifted against standalone Fitbit devices. Google recognized an opportunity within the struggling wearable brand. They offered approximately $2 billion for the entire company. This represented roughly half Fitbit's previous public valuation. Regulators raised concerns regarding health data privacy protections. Approval processes delayed the acquisition significantly. Eventually, regulators approved the deal after extensive review. Fitbit officially joined Google's expanding hardware ecosystem. Many Fitbit features began integrating into Pixel Watch products. The Fitbit brand continued existing but no longer led innovation. It transitioned into a supporting role within Google's strategy. Former competitors now dictated the wearable market's direction. Fitbit's journey offers critical lessons for modern business leaders. Being first rarely guarantees lasting dominance in technology markets. Early success can create complacency without long-term defensive strategies. Sustainable advantage requires moats competitors cannot easily cross. Hardware alone struggles when software ecosystems dominate value creation. Fitbit built excellent products but lacked platform depth. Apple and Xiaomi leveraged ecosystems to reinforce hardware success. Innovation must occur across design, software, services, and strategy. Speed matters as much as vision in competitive markets. Consumer expectations evolve faster than many companies anticipate. Brand loyalty fades quickly without continual value expansion. Market leaders must anticipate threats before they become visible. Fitbit pioneered wearables yet lost control of the category. History shows pioneers often open doors for stronger followers. Execution matters more than timing over long horizons. Great ideas require relentless adaptation to survive competitive pressure. The Fitbit story reminds us leadership is temporary without reinvention. You can shape the future and still lose the war.